All right, let's get right into it. Today, we are going to crack open what looks like a super dense technical stock analysis report. Our mission? To translate all that jargon and decode the signals so that you can see exactly what the pros are seeing.
I'm sure you've seen a report like this before. It's just this wall of text, right? It's packed with numbers and acronyms and phrases that feel like they're from another planet. It's definitely intimidating.
Well, if you've ever felt that way, you are in the right place. Think of this as our shared journey to find the secret decoder ring. We're going to break this down piece by piece and turn this confusing puzzle into a much clearer picture. Now, to make all this real, we're not just going to talk theory. We are focusing on a specific company that's at the center of this very report, Molina Healthcare. Its ticker symbol on the stock market is MOH. And, as you're about to see, their stock has been on one heck of a roller coaster.
I mean, just look at this journey. The volatility here is pretty wild. In early July, it's trading at over 231 bucks. Barely a month later, it completely craters, falling all the way to under 152. Then, you see this rally all the way back up to over 200 by early October. This is the kind of chaotic price action that makes analysts pull out their toolkits to try and figure out what on earth might happen next.
So how do they do it? Well, let's open up that toolkit and take a look at the key instruments this analyst used. We're going to tackle them one by one. First up, we have moving averages. Honestly, the best way to think about these is as trend smoothers. You know, a stock's price on any given day can be a really bumpy road. Moving averages help smooth out all those bumps so you can see the general direction things are headed much more clearly.
So put simply, a moving average just takes the average price over a set period of time, like say the last 50 days or the last 200 days, and it plots it as a single line on the chart. That line gives you a much cleaner, less noisy signal about whether the stock is generally trending up or trending down.
And this quote shows you exactly how the analyst puts it to work. They mention the SMA and the EMA. Don't worry about the names, they're just two slightly different types of moving averages. The key phrase here is tower overhead, at around $265. They're pointing out a really significant price level from the past that's sitting way above where the stock is now. It acts kind of like a ceiling. Traders call it resistance, and it could make it tough for the stock to climb much higher.
Okay, next tool, the MACD. It stands for Moving Average Convergence Divergence, which, yeah, is a total mouthful. So let's just call it the momentum gauge. It doesn't just look at the trend, it tries to measure the strength and the speed of that trend. You know, is the stock picking up steam or is it running out of gas? So the MACD works by comparing two different moving averages. When these two lines cross over each other, it can signal that the stock's momentum might be shifting, which hints that a change in direction could be on the horizon.
So what did our analyst find with this tool? The key phrase to focus on is neutral no crossover. What that tells us is that while one line is technically above the other, which is kind of positive, they haven't made a big decisive cross yet. The momentum isn't screaming that a big move is coming. It's more like it's in a holding pattern.
Our third tool is On Balance Volume, or OBV. This one is pretty fascinating. You can think of it as a money flow meter. Instead of just looking at price, it tries to track where the so-called smart money is going by looking at the trading volume.
The idea behind it is actually pretty simple. If a stock closes higher for the day, all of that day's trading volume gets added to the OBV total. If it closes lower, that day's volume gets subtracted. So a rising OBV line suggests that buyers are getting more aggressive, and all that buying pressure could push the price up.
And this is where it gets really interesting. The analyst points out that the OBV is showing a buy on inflow tilt. What that means is, even when the stock's price was getting absolutely hammered over the summer, this volume indicator suggests that buyers were quietly stepping in and accumulating shares. When volume starts trending up while the price is going down, that's often seen as a bullish sign that a turnaround might be coming.
Okay, so we've got our trend smoothers, our momentum gauge, and our money flow meter. But here's the thing, none of these tools tells the whole story on its own. The real art of this kind of analysis is combining all these different signals to build a complete case.
And when our analysts tallied up all the different indicators they looked at for this report, this is the picture that emerged. Out of 11 different signals, you can see a clear majority, 6 of them were pointing to buy. Only 3 suggested sell. It gives you a pretty clear visual tilt towards a more positive outlook. So, with all the evidence weighed, we finally get to the verdict. Based on all this data, the analyst then lays out what they see as the most likely future paths for Molina Healthcare stock. And here they are, side by side. The bullish or optimistic scenario sees the stock breaking through some of those price ceilings we talked about, the resistance levels. You see that first one marked as R1. On the flip side, the bearish or pessimistic scenario is that the price gets rejected at that ceiling and falls back down to a price floor or a support level, which is marked here as S1. It's all about these key price zones.
So what's the final call? A medium confidence buy. The analyst is basically saying the evidence leans positive, and the jargon that follows is all about strategy. Load on dips just means use any small price drops as a chance to buy, and stops nigh 195 means setting up a safety net to automatically sell if the price falls to 195, which helps limit any potential losses.
And this really brings us to the most important takeaway of all. Technical analysis is not a crystal ball. It can't predict the future. It's really a tool for managing risk and for trying to identify situations where the odds might be stacked a little bit more in your favor. It works by tracking historical patterns, not because of some kind of market magic, but because those patterns reflect the collective psychology of millions of investors, all of their fear, their greed, and their indecision, drawn out on a chart.
So in the end, the charts and the indicators, they give you a roadmap of possibilities. But what they can't account for is breaking news, or a sudden shift in the market, or just plain old human emotion. So the final question really is, even when you have the best map in the world, who is actually making the decision to hit the gas or slam on the brakes? The analysis gives you the odds, but you're still the one placing the bet.